This is the One Big Beautiful Bill Act, and there are some big changes coming this tax season because of what's in here. Changes that impact your income taxes, deductions, and credits. So strategies that helped you reduce your tax bill in the past may need to be reconsidered, and new strategies may need to be implemented to avoid paying more than you need to. To find out what families need to know and the changes that impact them, I reached out to my friend and trusted CPA, RoAnne Matsuura, for more information.
When I look at what's changing, the biggest surprise for families is going to be...
That's definitely going to catch a lot of people off guard. As a CFP professional, my team and I work with families who want to build wealth that lasts beyond themselves. And taxes are one of the sneakiest things that can quietly erode family wealth, especially if you're not paying attention. Knowing how these changes impact you isn't only important for today, because it also impacts your kids and future generations to come. Hi, RoAnne.
Hi, Troy.
I know you're ramping up for tax season, so I really appreciate you taking the time to speak with me today. I have a lot of questions for you, but first, I wanted to ask the question on everyone's minds. Will most families making the same amount of money this year pay more or less in taxes than they did in 2025?
That's a really good question. Of course, the answer is it depends. But what I can tell you is, in general, according to the Tax Foundation, taxes are going to go down on average, especially for middle-income taxpayers.
So what are some of the reasons why families could be paying less in taxes across the board?
The One Big Beautiful Bill Act makes many of the previous tax provisions permanent. Those were scheduled to sunset after 2025. This includes the income tax brackets and the increased standard deduction. The higher standard deduction remains in place, which means that more income is shielded from taxation.
Okay, so let's pause here. In plain English, a higher standard deduction just means a bigger chunk of your income isn't taxed at all. That's a good thing. For many families like the ones who don't itemize, this alone can lower their overall tax bill. Taxpayers were bracing for the rules to snap back to the old rules starting this year. If Congress didn't pass this act, then by default, it would have reverted back to the previous income tax rates and brackets, which were higher. Because OBA passed, income that was expected to be taxed at these higher rates is now still being taxed at the same lower thresholds. That's good news.
The One Big Beautiful Bill Act didn't permanently change how inflation indexing works, but it did give the lowest two brackets, the 10 and the 12% brackets, a one-time extra adjustment in 2026. After that, they grow with inflation just like the other brackets.
Tax brackets usually rise with inflation, but this extra increase at the 10% and 12% brackets means that more of your income is taxed at these lower rates. A common misconception is that this bump in the lower brackets only benefits low-income taxpayers, but that's actually not true. This change benefits high-income taxpayers too. Let's break it down. The IRS doesn't tax all of your income at one rate. They slice it up. The first slice gets taxed at 10%, the next at 12%, then 22%, and so on. When they make the 10% and 12% slices bigger, a greater percentage of your income falls under those two slices. Everyone pays the lowest rates on their first dollars earned. So when those low rate slices expand, everyone wins, not just the low earners. Okay, RoAnne, so there are a number of changes, but I don't think we'll have enough time to cover everything today, so I wanted to focus on just 3 of them that I think many families would be curious about. Number 1, estate and gift tax exemption increases. Number 2, SALT deduction temporary increases with the new income limits. And number 3, Trump accounts. This is the one everyone's watching because some people might qualify for a Treasury-funded deposit into the account, and no one wants to miss out on free money. Let's start with the first one. Exemption amounts are going up for estate and gift taxes.
That's right. The estate tax exemption is increasing to $15 million per taxpayer, up from approximately $14 million. This means that if you're married with a little bit of planning, your combined exemption amount is now $30 million.
Remember, income taxes are the taxes you pay on income you earn. Estate and gift taxes are taxes you pay when you transfer wealth. For example, a parent or grandparent giving money to children. You've probably heard before that estate taxes only affect the ultra wealthy, but that's not the whole story. Sure, at the federal level, the exemption in 2026 is high enough that many families won't owe a single dollar in federal estate tax. But here's what most people miss. If you live in a state like Hawaii, the state exemption is much lower, about 1/3 of the federal limit. Some states have an even lower threshold than Hawaii, like around 1 million or 4 million on the lower end. If the total assets in your estate are greater than the state exemption amount, there could be a state transfer tax that can range anywhere from 8 to 20%. And for the larger estates, the 40% estate tax could apply in addition to the state one. We haven't even gotten into inheritance taxes or capital gains taxes yet, but just looking at estate taxes, potentially giving 60% to the government, that's a lot. When you start adding up what counts towards the exemption threshold, your home, retirement accounts, investment portfolios, any rental properties or small businesses, it adds up much quicker than you'd think. So no, the estate tax is not just a billionaire problem, it's a planning problem. The estate tax can wipe out a large portion of your family's wealth, but you can shrink it or in some cases eliminate this tax entirely. This topic is complicated enough to make a separate video about it, so I will. I'll put a link in the description here when it's out. But to make sure you don't miss it, subscribe to be notified when it's available to watch. Okay, now back to RoAnne. Wow, RoAnne, that's a lot, $30 million. So this means married couples can gift or transfer $30 million of cash, real estate investments without any of it being taxed, at least on the federal side? That sounds pretty high.
It is really high.
I'm sure many families are thinking, we'll probably never hit that federal limit. Can you explain why this still matters?
Well, 10 years ago, the federal exemption was about 1/3 of what it is today. Go back a little further to the early 2000s and it was close to 1/10. It changed in 2017, it changed again in 2025, and there's nothing stopping a future Congress from changing it again.
It sounds like the exemption amount just keeps going up though.
That is true, but remember the exemption can go down just as quickly as it goes up. Congress can raise it today, but a future Congress can cut it tomorrow.
Well, it does make sense to take advantage of these higher amounts now while there's still certainty. Government spending is out of control. Right now, they're spending a lot more than they're bringing in. When that eventually catches up, they're going to have to look towards raising revenue somehow.
That's right. Whether they raise revenue by increasing income taxes or making adjustments to the estate tax in the future, it's not a matter of if, it's a matter of when.
Okay, so next I want to talk about the state and local tax or SALT deduction changes. Families might be interested in this because a higher deduction could mean a lower tax bill.
Right. One of the other notable changes is a temporary increase in the SALT deduction cap. The state and local tax deduction limit is temporarily increased to $40,000. That actually started last year, with the limit scheduled to rise each year through 2029 and then revert back to the $10,000 limit beginning in 2030. There's also an income-based phase down for taxpayers with modified adjusted gross income above certain thresholds.
Translation: basically for the next few years, taxpayers can deduct more of their state and local taxes, up to $40,000. This reduces their overall tax bill, but it's only temporary. It also gets smaller for really high earners and then eventually goes back down to the old $10,000 limit. Generally, you're either better off or no worse off with this change compared to the old rules. In other words, this change is either positive or in the worst case neutral. So RoAnne, could you explain why the deduction goes back down to $10,000 in 2030?
That is what we call a sunset. The higher SALT cap is only authorized through 2029, and the law is written to revert back to $10,000 in 2030, unless a future Congress votes to keep it higher.
Okay, so it's temporary, and that's the part families need to pay attention to. People may get used to a bigger deduction, and then in 2030, it could feel like a surprise tax increase.
That's right.
This is all really good information. Now I want to talk about the new Trump accounts because I hear some people are getting free money from the government when they open these.
I've seen a lot of confusion around that. It's not just open an account and it gets funded. There are conditions that families need to understand, and many of the details aren't even fully ironed out yet.
Got it, so let's break it down. What is a Trump account and who is it designed for?
Trump accounts are a new IRA-like retirement account created under the Big Beautiful Bill Act. They are designed to allow retirement savings for children before they have earned income.
So who's actually eligible to receive the money from the Treasury?
The Treasury's pilot program adds a one-time 1,000 seed contribution for U.S. citizens born between January 1st, 2025 and December 31st, 2028, when a tax election is filed on the child's behalf. Only one funded Trump account is allowed per child. Children who aren't eligible for the seed contribution can still get a Trump account.
So how are these new accounts taxed?
Contributions made by individuals are with after-tax dollars. Growth is tax deferred. Distributions are expected to be taxed like IRA distributions, depending on future guidance.
Okay, so it sounds like most of these new tax changes from the One Big Beautiful Bill Act are good news. Are there any not so good surprises?
Actually, yes. When I look at what's changing, the biggest surprise for families is going to be that even charitable giving won't reduce taxes the same way for high earners.
That's definitely going to catch a lot of people off guard.
The changes especially impact high-income taxpayers. There are two changes: a 0.5% AGI floor and capping the benefit of deductions at 35%.
Okay, so put simply, the first change says, assuming I itemize my deductions, the first 0.5% of my income that I donate doesn't count. I only get a tax benefit on anything above that threshold?
That's correct. You have to donate past the 0.5% of your income to start getting a tax break.
The second change confuses me even more. For the first time, the tax benefit for giving doesn't line up with the highest tax rate. Historically, if you're in the 37% bracket, giving to charity gets you a break at 37%. Now that's capped at 35%. It's kind of like they're saying we're shaving a little from the start of your deduction and we're shaving a little off the top too.
Yes, and I agree, on the surface, charitable giving can feel like an odd place to raise revenue. It's usually been treated as something Congress wanted to encourage as much as possible. I can only guess that it wasn't about discouraging giving. It was a way to raise revenue and narrow the benefit at the top without changing tax rates or touching the middle income tax provisions. The structure still rewards meaningful intentional giving. It just reduces the tax benefit slightly for those higher earners.
Okay, that makes sense. And I think it highlights something important. Some of the biggest changes in this law aren't obvious at first glance.
Right. It's not always one big dramatic change. It's a bunch of smaller changes stacked together. And for some families, those little changes can add up to be a very big difference.
Okay, so if there's just one thing families should know about filing their taxes this year, what would that be?
In 2026, you don't necessarily need brand new strategies, but you do need to review what you're already doing to make sure it's still the best for you now.
So what should people be doing right now to prepare?
First, double check whether the standard deduction or itemizing actually gives you a better outcome under the new rules. But more importantly, if you have a lot of income or multiple sources of income like a business, rentals, or investments, you need to make sure you're looking at the full picture, not just your taxes in isolation, but how they interact with your investments, your business structure, and your estate plan. Because income taxes are only one part of the picture, and when the dollar amounts get bigger, one missed opportunity or one wrong assumption can cost a lot.
That's the perfect message to end on. Thanks so much for the time, RoAnne. Look, I know taxes aren't the most exciting topic, but they're one of the biggest factors that determine how much wealth you actually get to keep and pass on. The One Big Beautiful Bill Act changed things in ways that won't show up until after you file your return, and by then it's too late to adjust. So do yourself a favor, don't wait. Review your situation now while there's still time to make adjustments. Lastly, if this video was helpful, share this with someone who needs to hear this. I have a couple other videos you should check out if you haven't already seen them. For example, how income taxes work, or what's the difference between a tax credit and a tax deduction. As always, thanks for watching, and I'll see you next week. Good? Cut? Done?